Yield nerds, welcome to episode 135. Chairman Powell earlier today says it is time to cut interest rates. What a great time to be in fixed income investing. I will share some key investing principles that I am following for Q3 2024. Make sure you do your own research. We are up to something like 368 subscribers. I've forgotten to update that, but thank you for your support. If you are new, please make sure you use the Income Investing Roadmap, which is a playlist. And most importantly, I have no magical powers, so make sure you check and do your own due diligence. There are four parts in this episode. The first one, as always, will go check the market temperature. It keeps me very real and based in reality to compare myself against the market indices. And sometimes I do well and sometimes I don't, and we'll see how that goes this time. The next part we'll look at is what are the most possible, plausible paths forward for yield and equities. At least I'll give you my impression. And I have now constructed a very interesting tool which I call my personal yield curve. And I'll tell you more about it and review my trades and next steps. So let's kind of see what is happening. And this is the NASDAQ and the S&P. And what you can see is this giant wave, it goes up by 3, 4, 5%, crashes down -4 and goes up. And, I suppose if you're a growth investor, you expect that kind of a ride. On the other hand, I'm that blue line there. My portfolio has returned, give or take 7%, most of it state tax free. So that's my world. And if you live in the equity world, in the long run, it does look like equities do wonderfully well. And I do plan to switch there. Some of you know that I barely have 1.25% in equities, and I intend to make that bigger, but on a measured basis and slowly. As of now, my asset allocation shows that I have an overwhelming majority in fixed income, and within that, treasuries have 77% of my allocation, and agencies have 12 something percent. Corporate bonds are catching up very, very quick. I am starting to allocate more there. And so I do have investment grade corporate bonds, about 8% of them. And muni bonds, I'm getting there very slowly. I haven't found anything that I absolutely want to jump to. And I have a really small amount of preferred stocks, and I'll review them as we go along. So that is where I am in terms of asset allocation, in terms of duration. Even in an economy where interest rates have been declared to go down, I am still very short term. I haven't panicked and jumped over to the long term. And part of it is my thesis of where the election is going to take us in terms of the ups and downs. So I am sitting here patiently waiting to capitalize on potential volatility right around the election. So having said that, you do see that I am starting to increase my allocation on the very long end, and those are the corporate bonds which pay a very good coupon and are trading under par. So, in my research, as I stand on top of a mountain of eggs, which I'm very excited about, and with oil barrels around me, and those are my value stocks, there are multiple paths forward for equities and fixed income from where we are. Even though Chairman Powell says we're going to drop interest rates, I'm going to review what I believe are the paths forward. Please remember, this is not investment advice. It is not tax advice. I am not a wealth management advisor, and I don't do politics and product pitching. I don't have pink sauce to sell you. Not that there is anything wrong with it. I just don't have it to sell to you. We reviewed treasuries and how the curve has gone up and down, and where I thought it could end up over a longer period of time. And there are some indications of the front end of the curve rapidly decreasing, and in short order it will be below 5%. That is pre-sales tax. So when stuff like that happens, we need to start thinking about what the future holds. And I suppose there are three paths forward. And one is, the Fed just starts dropping interest rates very, very quickly, 1%, 2% in the next 6 months. And that will mean everybody runs away from fixed income. Where do you go? The most likely place, you would argue, is equities, and therefore equities will go up like crazy. And in the equities forever plan, a couple of other things need to be true aside from a rapid reduction in interest rates. We also kind of sort of need world peace. I'm just saying, in a calamitous world, you can't really expect every equity in the US to rise. And there is one more thing. We also need consumer demand. So the bull case on equities already being at a high to continue going higher and higher and higher would need all three of these, in my opinion, not just one or two of these three. And that is why I'm not subscribing to the bull case across the board. And that is why I haven't moved from 1% to 30% overnight. I am being very measured. Now, what about the bear case? The bear case says kick that barrel of oil, sell away most of your eggs, equities are going to go nowhere, and yields are actually going to increase. Even though Chairman Powell says what he's saying, after the election, it is possible we'll look at the debt load and go, oh my God, what have we done? And we decrease spending, and we suddenly say we're going to have to figure out how to finance this. Our currency crashes, yields increase. That is one possibility. The other fixed income theory is Chairman Powell fully intends to drop interest rates, but for various reasons he is not able to. Maybe demand is lower for a certain reason. That may or may not happen. Obviously, we reviewed a previous episode where I indicated my opinion that the US is the one-eyed king in the land of the blind. And the third possibility is there is some kind of a calamitous event in the world and we are rushing to safety, and such safety is not consumer discretionary stocks and all of the other sectors. It's fixed income. Those three would mean yields stay high. Realize in the previous case, in the equity bull case, it was a series of and. Here it is or. And so what is the reality? It probably is the middle of the road of both of them. Yields probably will drop, but it's unlikely Chairman Powell crushes it with 2% over the next 6 months. There will be possibly some level of global stability, but world peace isn't, anywhere within reach, unfortunately. And as interest rates stay high, they don't have to be low, they are higher than they ought to be. A lot of these highly leveraged companies that have a lot of capital investments already cannot survive, and they start collapsing. And so my instinct tells me the third scenario is more likely in terms of where it would go. And to prove my point, I'm going to show the crack in the eggs, pun intended. The blue mountain here, surprise, surprise, is NVIDIA. NVIDIA is the darling of growth stocks, but even it had big ups and downs. And, the last 3 months for NVIDIA has been a roller coaster ride. Having said that, the red line is vital eggs. You may remember vital eggs I called, in all jest, vital eggs I called the NVIDIA of eggs, because it is very high priced. It's the free range eggs. It sells for $9 a dozen right next to the Eggland's Best, which sells for $3 a dozen or $4 a dozen. I mean, it is the coolest egg there is. And the owners are selling quite a bit of vital egg stock. Look it up. And that has seen a turn in the last 3 months. And you go, okay, if NVIDIA is the blue mountain and the orange is coming down, crashing to the earth, what is that blue or the purple? That is Cal-Maine Foods. The slow and steady eddy is up 22% in the last 3 months. And they posted okay earnings. It wasn't stunning, but it was really good. Excellent cash flows, dividends. My point in all of this is the bull case, the bear case, and the realistic case. I remain very convinced to stay on the value side of the investments, but that is me. On the energy side, the momentum is getting sucked out of energy stocks because the theory is that, oh my goodness, if the world is going to slow down, then we're not going to need as much oil. All within a reason, true. But in the last 3 months, for stocks like TK Tankers, Ardmore Shipping, Chord Energy, things with zero debt or very low debt, extremely high net profit margins, extremely high cash flow and return on investment capital, for these stocks to drop, I find it puzzling. So I am actually acquiring bits and pieces of these and hoping for a better day. So I'm going to go on to therefore, what am I doing in the interest rate drop environment? I've organized my portfolio by taking an extract from Schwab and creating what I call a personal yield curve. Now, what is a personal yield curve, you may ask? Well, here's how I'm thinking about it. Let's say that somebody bought a fixed income security, and I'm going to make it very, very simple here. Somebody bought something for 95 bucks, and in 2 years, it's going to become 100. And I'm using simple logic. In a year, it's going to become 97 and a half, a linear line going from 95 to 100. Let's say that you are a year in, and instead of 97 and a half, it's trading at 98.9. Part of the reason you would argue it's trading at 98.9 is, hey, you know what? I know we're only 1 year in, but interest rates are dropping, and you can't buy another 1 year security with that same kind of yield, and therefore we are willing to pay more to get this security that matures in a year and only makes $1.1. That's the argument. I see that as an opportunity. I see that as a way to make a profit of a buck 40. Now take the 98.9 and not invest in a 1 year time period wherein I would make less than $1.10, but instead extend duration, go to corporate bonds, buy things in a discount. That is the game I want to play with ease. How do I do that? Here is how I would do it. On Schwab or any of your brokerages, I'm sure there is a way to download your portfolio, your fixed income portfolio. I couldn't care less whether you have $1, $100, $1,000. There is a cost per share for the fixed income instruments you own, and there is a trading price. All of them have an expiration or a maturity date. And you can then convert the difference between, quote, today and the expiration date into a number of days. That's the duration in years. This is the coupon. I'm sorry, the columns are being hidden here. There you go. So you have the expiration, you have the duration based on the expiration. You can then, when you download from your brokerage, you should have your coupon. And you can very simply use this formula, yield math on Excel. I don't know if you use Google Sheets. I don't know the formula there. But you would use the formula of your choice with that information to compute yield to maturity. Multiply yield to maturity by 1 plus your state tax. You get the pre-tax yield to maturity of your treasury because treasuries are state tax free. So now you have your own yield, you have your own duration, and you can then, ta-da, construct the orange line, which is your own yield curve. You can get the Fed yield curve, and the reason the Fed yield curve is only a handful of dots is because you can buy a 3-month, a 6-month, or a 9-month, but what you may have bought may have a fraction of that in between. And as you can see, I own a bunch of fixed income instruments because I'm obsessed with this stuff. And so I have several of my bonds, and a lot of my portfolio matures in very short order, but I am going to the other side. But I can just eyeball it very quickly and see if I am beating the Fed or I'm on par in terms of my yield to maturity. The orange line is my personal yield curve, and the blue line is the Fed's yield curve. And I see some problems here, or as I call it, opportunities. These have a lower yield between now and when it matures. You know why? These are examples of the 97 and a half trading for 98.9. And so I'll sit here and go, interesting. So what you're telling me is you're already paying me most of the $5, the difference between the 95 and the 100. I can sell those, buy things that are either higher yield, same duration, or I'm willing to extend duration because the market is in a falling interest rate environment. I can extend duration and get a higher yield as long as I can beat this yield, because I've already made the $98.90 using our example. As long as I can beat the $1.10 for the remaining year using our example, I am going to have more income, not less. So when you are able to do that, you will know on your portfolio what you need to sell. I sold some agencies, I sold treasuries on Schwab. As long as you bought treasuries there, you should not have any fees to buy or sell treasuries. And if you bought the agency on par, you should not have any losses. And if your agency trades above par, cha-ching, you actually make a profit as well. So a lot of good things here in terms of what you can do. And I really don't even react to the coupon at the end of the day. Here is something that makes 4.6% for the next 2 years, but the market is already pretty much paying me that yield to maturity. And there is very little left between now and 2026, which is why I sold those. So you need to look at your own yield curve, compare it to the Fed's yield curve, and you will know what to do. Here is the most important thing I learn to myself, I tell myself, which is to be flexible. And don't drink your own Kool-Aid. There is a reason why I don't call this treasury nerd or corporate bond nerd. If you listen to some of my older episodes, I diss on corporate bonds about a year and a half to something like that ago because I say, wait a second, who wants corporate bonds? That thing is terrible. That's because compared to treasuries a year ago, corporate bonds were terrible. Today, they look good. The same for select munis and so on. So you have to constantly plot you versus the Fed's curve, tax adjusted, and then make the decision to beat the yield curve at each duration. If you've already earned the yield, this is what I did, you do you. But if I've already earned most of the yield and the difference between now and the maturity date is a very low yield, I would happily give it up and trade. Equities are a wonderful option, but I'm not going to just jump to equities because Chairman Powell says he's going to drop rates. I still am going to look at fundamentals, and I traded some equities and some fixed income, and let me tell you what they are. First of all, you may remember from the past few episodes, I brought some of those corporate bonds. All of those bonds are trading above the amounts I bought for a very simple reason. In a falling interest rate environment, longer term bonds bought below par will approach par. It's that simple. And so I intend to keep them until they trade above par, and then I will dump them. And so all three of those are corporate bonds that I bought below par. And I still buy treasuries. I still buy them where the yield is higher than my other uses. And as far as equities itself are concerned, I am up 7% compared to where I started. Red Cat is my top, and you can see the rest of the equities I hold. Now, one of the things I will point out, there is a new equity that I bought called ELTP. That is in addition to another equity I bought called ITCI that I reviewed the previous time. I'm not yet ready to discuss ELTP. Please remember ELTP is an over-the-counter pink sheet, as it is called, so there are extra fees when you trade it. I made a really small investment. I'm gonna learn more about it as I progress, and I will review it. If I still am very favorable towards it, I'll give you my rationale. Hey, remember, even a broken clock is right twice a day. Don't trust me. Do your own homework, and thank you for watching Yield.